Never co-sign a loan. Ted's here to discuss it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, so today's topic, never co-sign a loan. And this is the first episode I think we've ever done where I just hand wrote some notes. You don't have anything. We normally record on a Monday. Today is Friday, and we just said, hey, let's do this. So here we go.
And this is because the topic is a slam dunk.
Well, yes. So the topic is never co-sign a loan. And I'll give everybody the answer right now as to why that is. Because if you co-sign a loan, you get all the risk and none of the benefit.
Well, there might be some benefit that non-financial benefit, you don't know.
Well, okay. And
helping family or friends.
So let's talk about that. And that would be why you would co-sign a loan. So let's, and I've already given the answer. I think you shouldn't do it.
Right.
But what we'll do is we'll put timestamps in the episode so you can skip around if you want to go to a specific part. So you have no notes here. You only found out the topic 30 seconds ago, but that should be fine. So explain the difference between joint and co-signed.
Right. So a joint debt, you are a co-borrower. The two individuals or whatever number of individuals are involved are taking the loan out together. So you're involved in the entire process. When you are co-signing, you're saying, I'm going to guarantee that the person that's actually borrowing this money is going to be good for their payments. If they aren't good, you can come after me.
So an example of a joint debt would be we buy a house.
Yeah, typically most mortgages now have both spouses sign for the document. They are co-borrowers. They're both equally responsible for that mortgage.
And they both have the risk, but they also both get the benefit because they own the house.
Presumably. Well, not necessarily with a house, right? They may have both signed the mortgage without both being on title.
It's possible, but presumably the reason they're doing it is because they're both living in the house.
Right.
So they're both getting the benefit.
Who the hell can get approved for a mortgage now big enough to buy a house anymore, unless there's two people involved?
Well, or your parents as well.
Right.
Whereas if your buddy says to you, hey, Ted, I want to buy a car and I didn't qualify, will you co-sign for me? Then your buddy gets the car,
right,
and you have all the risk.
I get all the risk and get no benefit, except for the moral benefit of helping my friend.
Right, and I guess that's what we're going to talk about today. So here's why I don't think you should co-sign a loan. Let's take this example of your mythical friend who is buying a car that is worth $30,000. I don't know can you buy a car for $30,000?
Getting a Honda Civic.
There you go, a Honda Civic for $30,000. And your buddy comes to you and says, hey, Ted, I had a bit of a rough time, was unemployed for a few months, but I'm back on track. I need to buy this car so I can get my job because I got to go all over the place.
Right.
$30,000 car. And you go, okay, well, what's my risk here? Right. And you would think, well, it's not that much of a risk, right?
Well,
because
as long as he makes the payments, there's no risk.
Right. If he doesn't make the payments, though, I guess the lender is just going to take the car and sell it.
Maybe.
So, how much could you possibly lose on this deal?
You could lose $30,000.
So walk me through how I could lose $30,000.
First thing that happens when you buy a car, as soon as you drive it off the lot, it depreciates. And there's no telling how much it's going to depreciate. Depends on what's going on in the market. Everybody always assumes 20%. So let's use that just so we're talking. So that $30,000 car, you drive it off the lot, is now worth $24,000. You lost $6,000 just by driving it off the lot. So if your friend doesn't make any payments on it at all, and you're co-signed that $30,000 loan, you could now be stuck paying $30,000 for a $24,000 car, even if you actually get the car. But let's say your friend beats the living hell out of the car. They don't maintain it properly. They take it out in the fields. They have some fun. And so now the car's worth $500. Nobody wants this thing. Well, the loan is still $30,000. And if they don't get paid by the person who borrowed the money, they're going to go after the cosigner for the difference.
Well, I'll give you another scenario. Our mythical friend here runs into some hard times, can't pay his insurance. So now there's no insurance on the car and he gets into an accident or whatever. Right. Once again, you've got a car worth zero.
Yep. Or he sells it outside the country.
That would, or
drives it to Pennsylvania and sells it.
And then it doesn't matter because they can't do a search on it. So there are a whole bunch of scenarios where you can end up losing everything.
Correct.
That's the point. So if you are co-signing, you have to understand I am taking 100% of the risk.
Right.
It's as simple as that. Now, there's another problem, not just the $30,000 you lost, but there's also the credit impact.
Correct.
So when you co-sign a loan or have a joint loan, that very well may get reported to the credit bureau.
It should.
And as a result, you have now soaked up a bunch of your borrowing ability.
Right. You need some of your utilization rate too, because not only is it your borrowing ability, but somebody did borrow the money, so it's using it up.
Yeah. And so your utilization rate, okay, maybe that actually helps you because you've ended up getting another loan.
Right.
But where it can really hurt you is 2 weeks later, you decide to go buy a car and you walk in and hey, I got really good credit. And they go, oh, you've already got a $30,000 loan. Given your income, you can't get any more.
Right.
Great. It's an 8-year car loan I just co-signed for. Does that mean I cannot borrow? I can't get a car for the next 8 years?
Maybe.
Maybe.
Yep.
So those are the two big reasons why I say you should never co-sign a loan. Now, you raise the other side of it, which is, come on, Doug, stop being such a, ornery old man here.
Well, the most common example of a cosigner is a parent, some kind of family member, but almost always the parents.
Okay, so you go to your parent and say, hey, I need you to co-sign for me.
Mm-hmm.
Well, you're a parent. Now, I don't think your 12-year-old is getting a whole lot of loans at the moment, but,
Hopefully not.
When they're older.
They just pay for braces.
You see? It does cost money. So,
right.
So is it... So as a parent, I guess, you feel morally that you should help your kids?
Well, that's what a lot of parents do. I mean, my children know that I will not be co-signing any loans for them because I'm an accountant. Mm-hmm. We know better.
Yes, and I have also never co-signed any loans for my kids, and they're older than your kids. So,
right.
So does that make us bad people?
No, it just makes you financially conservative, right? You never stop being a parent. If your child needs something and you're able to help them, lots of people do, but are you actually helping somebody that can't get approved for a loan by empowering them to get the loan?
Now you're hitting on the topic. So, okay, we're not going to co-sign, but here's what you could do. You could still help your friend. So in this particular case, why is it that they don't qualify? Well, their credit isn't good enough.
Right. Something's wrong.
Something is wrong. So I got a couple of suggestions. One suggestion would be, can you help them improve their credit? Mm-hmm. Maybe they just don't understand how the system works. Maybe they got a couple of things on there where they didn't pay their phone bill on time, and as a result, their credit's bad. Right. Okay, well, let's get a copy of your credit report, and you and I do this with our clients all the time. Let's go through it, see where the problems are. Maybe you can fix it. Yep. Might take a month or two, but maybe you can be in a position to get the loan on your own.
Sure.
Isn't that helping a lot better than just signing a piece of paper?
Yeah, you're doing that whole, give a man a fish, you feed him, teach a man to fish, he feeds himself.
And there's another one where...
There's a third one.
Yeah, there's a third one. If you teach a man to light a fire, he could be warm for the rest of his life if he burns himself or something. I'm not sure. We'll have to look that one up. So one way is help them improve their credit. Maybe it's like, what I'll do is I'll co-sign on a small credit card for you, which maybe boosts up your credit, and then you can get the $30,000.
Yeah, I wouldn't do that either.
You're on the hook for whatever the credit card is. That's the problem.
And credit card companies keep raising the limits without telling you as a co-signer.
Okay, so we don't like that idea. I mean, maybe the reason they don't qualify is because they got a whole lot of debt, in which case you're going to be suggesting, well, do a consumer proposal and clean up your debt that way. Okay, there's another way you could help, and that is just give them the money.
Right.
So
assuming you have the money.
Well, exactly. But if you're co-signing, you're assuming you've got the ability to pay off the loan anyways.
That's true.
So in this mythical car loan example, your friend only has $500 of a down payment. They're not going to give him the loan without a co-signer. But what if he had a $5,000 down payment? Would that make a difference?
Sure.
So there's an option. I'm not going to co-sign for a $30,000 loan because, as we already discovered, you might lose $30,000. But you know what? I'll loan you $5,000 towards the down payment, and therefore you'll qualify on your own.
Sure.
So in that scenario, my risk is $5,000, not $30,000.
And if it's a family member, I just give them the money. Assume it's not coming back.
And that's in my book, Straight Talk on Your Money. That's exactly what I said. If you want to help someone out, give them the money.
Right.
Because if they're not able to pay, you're on the hook for it anyways. So here you go. Here's the money. And if you can pay me back, great. But I'm assuming in my own head, I'm never going to see it.
And your attitude will be better. Like if you both of you, if there's a loan between family members or close friends, it puts a layer of stress on things. If you just give a gift to them and you don't think about it ever again, you'll be happier.
Yeah, because what is Thanksgiving dinner, Christmas dinner going to be like when your brother has this debt that hasn't been paid and you both know it,
and you find out he just booked he spent a New Year's in Vegas or something, but he hasn't paid you back.
Yeah, so now there's a whole lot of stress. Whereas like, okay, I really do want to help you out. Here's the cash. I'm going to do it.
Right.
Okay, so that's the show. That's why you should not co-sign a loan. Now, there's a whole bunch of people watching who are going, we don't care. We're going to do it anyways.
Right.
We don't care about you guys are just old meanies. We're going to do it anyways. Okay, so part 2 of the show is, if you're going to co-sign a loan or do a joint loan, what can you do to mitigate the risk?
Right.
Okay.
Well, so if you're co-signing on an asset, they want to buy a car or something, make sure your name's on the registration too.
Okay, so that's good. So what you're talking about basically is security.
Correct.
So a car can be owned by more than one person?
It can be.
And so what's the advantage of having my name on the car as well as having it on the loan?
Well, so first, the car can't be sold without the owner signing off on the agreement, and it can't be refinanced without the owner signing off. So if your name isn't on the ownership, they could trade it into somebody else. You'd have no control over it. They could refinance it through a second company. You'd have no control over it. This way, anything that happens with the title on that car, you have to be told.
So you have more of an interest in it then as a result of that.
Well, you own half a car.
You own it. It's your car as much as it's their car. Okay,
Right.
So I like that. We already kind of touched on this. You could loan them the necessary down payment.
Right. Or the entire purchase
Or
price.
the
if you
entire
wanted to,
purchase
if
price,
you're
yeah.
able.
And then you're there. And then I guess if you were going to do that, and if you're actually going to do it as a loan, not a gift, then you can have some pretty strict terms of repayment.
Well, in fact, for it to have any legal basis, there's certain structure that loan has to have. You have to have a stated interest rate, requirement payment plans, the actual cost of borrowing the money from you. There's all sorts of things that make it a legal document, as opposed to, I write it on a cocktail napkin. Ted's going to loan Doug $5,000 to buy a.
Get me a cocktail napkin right now, people, so we can do this deal. So yeah, you actually do up a loan agreement, and you're probably not going to go to a lawyer to get it done.
No, you don't need a lawyer.
But it's a piece of paper that says I'm borrowing this much, and the interest rate is this much, and I'm going to pay it back at the rate of $100 every 2 weeks, every other Friday.
And if you want to get really fancy, you put in a default clause. And if you miss 3 payments, I get to take the car or whatever it is.
Whatever it is. And that way, there's no confusion. This is a loan. Here's how it gets paid back. And then, okay, you're going to interact me the money every 2 weeks.
Right.
Or maybe I can somehow set it up to take it out of your bank account. I don't know. But there's a plan in place to get it paid back. So, okay, I like that. And then you already had the other one on my handwritten list here, which is get the loan yourself.
Right.
And the advantage of that is you might actually get a better interest rate.
Probably will, if your credit in better shape.
Then rather than co-signing for your buddy to get a loan at 20%, well, maybe you can get a loan at 10%.
Right.
And your buddy can just pay that interest. So that might work.
Or you could charge the buddy 20%.
There you go. Now we're making some money here. And maybe
we're
you will.
accountants. We can't help ourselves.
We can't. It's just the default for us. It's the same risk. If you're co-signing a $30,000 loan or getting a $30,000 loan yourself, you're on the hook for $30,000.
Now, it may be reported differently on your credit bureau. So for sure, if you take the loan out yourself, it's going to be on your bureau.
Right.
If you're co-signing the loan, it's not clear. It should be on your bureau, but you never know.
Well, and I guess if you're getting the loan yourself, you're in complete control over it. So if in my previous scenario where you now want to go buy a car, okay, well, I guess what I'm going to do is tap into my TFSA and pay off the loan so I
do something.
My credit looks better. So, okay. The third thing on my list here is a joint loan so you can track the payments.
Yep.
So this is my other concern then. So we've got this loan out there, and how do I know if my buddy's making the payments?
Right. If your name isn't on the loan, you've got no right to see it.
Exactly. So if it's a loan, a line of credit, whatever, maybe it's through a bank, not through the car dealer, well, then I can actually see it on the screen.
Yep. Well, and you could achieve that same result, or almost that same result, if you had simply had a joint bank account that the payments came out of. So maybe you don't actually sign on the loan at all, but you have a joint account in both your names, and the payments come out of that account, so you can go online and look to see the money has been deposited, the money has been taken out.
And I like that idea. So, okay, here's what we're going to do. We're both going to go to a new bank. Maybe it's the same
wherever
bank
you're taking the loan out from.
Right. And we're going to set up an account. It'll be in both of our names, and we'll specify that there's no overdraft protection on this. We don't want things bouncing and all that sort of stuff.
Right.
But then, yes, you can go in at all times and take a look to see if the payments are being made. Now, I've got another worry, and that's insurance. So, great. You're making the loan payment every 2 weeks. How do I know that there's still insurance on this mythical vehicle we're talking about?
Right. And the only way you'll know that is if your name is on the policy.
And to be on the policy, you pretty much have to be on the ownership.
Not necessarily, but it's certainly easier.
So you could be a named insured, I guess.
Right.
Well, we rent this premises here at Worldwide Headquarters for Hoyes Michaelis and Debt Free in 30.
In Geneva, Switzerland.
In Geneva, Switzerland. It's an unknown location.
I just told them.
Actually, it's in Kitchener. But okay, Geneva, Switzerland. So if the building burns down, well, we've got insurance for the contents or whatever. We don't own the building. So I guess it's possible to be a named insured. So you can see as you think this through that there's a whole lot of things that can go wrong here.
Right. And we're just talking about cars. Think about a loan for something, well, just a personal loan where it's not clear what they're going to do with the money. That's even riskier because you've got no security and there's no real recourse.
Yeah. So my buddy needs to pay his rent at the beginning of the month. He needs $2,000. I say, okay, fine. I'll loan you $2,000. Well, I don't have a lien on the guy's car or anything like that.
Right.
Now that is something we skipped over. So if it's a car loan, and if you're going to loan them all the money, would you put a lien on the vehicle?
Certainly.
And how does that work? How complicated is that?
So here in Ontario, you use the Personal Property Security Act. You probably use a lawyer's office to do this because individuals, you can't go online and do it yourself. It's not a big fee. And you simply register against the individual's name and against the VIN number on the vehicle saying that there's a loan outstanding in the terms and when this registration will expire.
Yeah, and I'm sure there is a way to do it yourself, but I'm not an expert in that. I don't know if you can go to Service Ontario or how it works.
Never tried.
I've never tried either. But if it's a $5,000 loan, you're probably going to say, well, I'm taking the risk. If you're loaning $50,000 so they can buy a car,
right, then
yeah, I want to be registered on title. Sorry, I want to have my loan registered against the vehicle.
Yep.
So either the vehicle's in my name.
Well, and there are implications for what we do as well. So let's say somebody is in financial trouble. They're looking at filing a proposal or a bankruptcy, and mom and dad actually gave them the money to buy the car. The car is worth $30,000. Well, you're only allowed to keep a car worth $7,100 in Ontario. That means the person filing the insolvency, the bankruptcy or the proposal, has got to come up with $23,000. If the parents put a lien on that car, a properly documented loan and a lien through the PPSA, then there is no value in the car. It's secured against the debt.
Yeah, and that's a very key point because we have people come to us all the time. In fact, you were telling me a story an hour ago. Person's filing a proposal. They've got a car that's worth, I don't know, $10,000 and the loan is $20,000.
Right.
And your first thought, which would my first thought is, do you really want to keep paying for a $20,000 loan for a car that's worth $10,000?
Right.
And in this particular case, I don't know, maybe he can't qualify for another loan. There may be mitigating factors.
He doesn't feel he had any choice, but
okay, let's say the scenario is I'm going to give up that vehicle, include the shortfall in my proposal, and my parents are going to loan me $20,000 to get a replacement vehicle.
Right.
Cool. Our advice to the parents, if they came to see us, would be exactly what you said.
Right.
Do a formal loan agreement, register the lien on the vehicle, and that way, if your kid ends up in a proposal or going bankrupt, there's no doubt it's a secured loan. You can keep paying it.
And what most family members do is the parents have title registered on the car and they name the kid as an insured driver.
And that probably gets them better insurance rates too.
Yep.
Until the kid has a couple of accidents and now the parents' insurance rates go up as well. So
correct.
Again, you can see there's a whole lot of things to think about. Now, what about the case of a parent who is giving I'm going to help you with the down payment on a house?
Right.
Anything different there?
I mean, the issues are still the same, right? You're giving somebody equity in this new asset. And if you want to be sure, well, given that 56% of all marriages end in divorce, perhaps you don't want to be giving your child's partner that 50% if the marriage breaks down. So registering on title as a second mortgage isn't a bad idea. I mean, it depends on your finances and how you trust your kids, but that's what I would do.
Yeah, exactly. And there's a timing issue to this too, because
Correct.
when you go to get the mortgage, the bank is going to say, well, where's the down payment coming from?
Right.
And so the parent has to say, oh, I'm gifting it to them.
Well, and I did. I gifted a chunk of money to a family member that needed to buy real estate in Canada because they'd never lived here. And that's the bank required a note that said, yes, this is a gift. There's no obligation to repay.
Right. And that because the bank's saying, look, we're lending against the property, but we only lend up to, let's say, 80% loan to value.
Right.
So we want to know that the 20% you're putting in isn't really a first mortgage or any other kind of charge. So you sign off saying it's a gift.
Yep.
The bank does the mortgage. And then what, 2 days later, you register the mortgage?
No, in this case, it was when you sell this house, you better be gifting me something.
Yeah, because it was a family member, so you knew where they lived.
But
and
it
they
wasn't,
knew where
yeah,
you lived.
it wasn't treated as a loan. I assumed I'd never get it back.
Right. Did you ever get it back? You don't have to answer that question.
I did.
So you did. There you go. So it's a happy story.
Took 12 years.
There you go. So yes, what a parent would typically do, and I don't know if Ron, the mortgage guy, is watching this because probably what I'm about to say is wrong. But okay, here's the $200,000 because to buy $1 million house, that's what you need,
Right.
And it's a gift. I sign off. I say it's a gift. Everything's a gift. The bank does the mortgage. You lock it in for 5 years. And then the next day I go and say, okay, new agreement. I'm taking the gift back. Here's the second mortgage. We're registering on title.
I suspect you could do that legally by advancing them new money as opposed to what you just suggested.
So you give them
Another $5,000. So unfortunately, I'm going to register on title on your
for
house.
the whole 205.
Right.
There you go. And the bank at that point doesn't really care because they're in first position. You're in second position.
Correct.
Now, when the mortgage comes up for renewal, is it going to be an issue? Well, I guess we'll worry about that in 5 years.
I mean, the bank's concern is that they're in first position and also that their payments are going to get made. So depending if that second mortgage now has requirement for payment terms, you could have issues when you try to renew.
Right. And the bank may also say, you know what, again, even though you've got this $200,000 down payment from your parents, you still don't qualify on your own. So maybe the parents end up co-signing anyways.
Right.
Maybe the parents want to be a 1% owner. There's a whole bunch of, again, things you got to think about. And in the case where your kid is single, I guess you don't have to worry about their partner.
Oh, but they could have a partner in the future.
Right. And so that's where registering that second mortgage means your interests are protected.
Yep.
And so it's not a bad idea. Okay, the final thing I had on my list here, and this is we're mitigating the risk here. Okay. So taking back security, you loan the down payment, you get the loan yourself, you do it as a joint one. My final thing on my list is hardcore monitoring, which is a phrase I just made up.
Right.
Sounds kind of dirty, actually. And so what I mean by hardcore monitoring is, okay, I want to make sure I've co-signed this loan. I want to make sure you're paying.
Right.
So every month I'm going to either check our joint bank account to make sure the payment's out.
You want some way to verify.
Or like, what else could you do? I mean, let's go back to our days 35 years ago as auditors. I guess it's, I want you to send me a screenshot from your bank every month when you make the payment.
Yep.
I want to, maybe you're going to interact the money to me and I'm going to make the payment.
Yeah,
and then I know absolutely for sure it's being
of course,
made.
then they may not know. Do they trust you to make the payment?
Well, Gets
interesting.
This is a
because
very
everybody's
good point.
life can change.
Yep. So is there anything else you can see? And again, maybe I'm going, way overboard on that, but
we're back to the whole premise at the beginning. Don't co-sign for anybody.
Yeah.
There's very little upside ever.
And have you ever done a bankruptcy or a proposal for somebody who co-signed a loan and it went bad?
This week?
Yeah. So it happens all the time.
Right.
It happens all the time. And the most common example probably is a parent, but
family member for sure.
Yep. Or, my old girlfriend, my old boyfriend, whatever. That's what,
So joint debts are usually with old boyfriends, old girlfriends, old husbands, old spouses. Co-signed debts are usually family members, uncles, aunts, parents, grandparents.
And so let's pick on your uncle here.
Right.
So your uncle comes to you and says, hey, Ted,
He would say it like this. Hey, Ted, one day I'm going to make an offer.
Yeah. and you say in your head, no.
Yeah.
But how do you say it to your uncle? Because this is your uncle. You've known him since you were born,
Right.
Like how do you say other than just no?
Yeah.
How do you explain why you can't do the deal?
Well, so the best way to couch is to say, look, if I were to co-sign or somehow jointly borrow with you, then it's really me that's borrowing the money, so it won't rebuild your credit. It's not as beneficial to you. Let's have a look and see if there's a way we can find to get you improved by yourself.
Yeah, and I do like the angle of this is going to impact my ability to borrow.
Right.
Because now it shows up on my credit report as well, potentially. And I've only got so much borrowing room. I mean, we know how the banks do it. They go, well, you can borrow up to 35% of your income, Guess
Right.
what? You've already used it all up. So I'm planning to buy a car, buy a house, make an investment.
3 kids going to university, whatever.
I got a whole bunch of things. So I'd love to help you out, but I just can't.
Right.
And I assume your uncle knows that you're, reasonably well off. And as a result, you probably can afford it. That would be an even better excuse. You know what? I can't do it.
Right.
I can't. I do not. I've got debts of my own. I owe this. I owe
My
that.
family members all know that I won't do it.
That's right.
The
So
conversation doesn't get
they
started.
don't bother asking.
Right.
But yeah, I think it's the kind of thing that the listener should be thinking in their head right now. Okay, so what would I say? How would I approach this? What would be
How do you say no to
How do you
somebody?
say no? And I think the best answer is you say no.
Right.
You be very direct about it. But
Yeah, don't equivocate.
I can't do it.
Right.
And I won't do it.
Mm-hmm.
And one of the reasons is it's going to impact my credit. One of the other reasons is I don't have the ability to borrow. I don't have that much money, whatever. But here's what I am willing to do.
Yeah. Here's how I can help.
I can give you a gift of $1,000 because that's what I got in my TFSA. Your family, I'm willing to take it out.
Mm-hmm.
I'd love it if you can pay me back someday, but I realize times are tough, whatever. So maybe you can go to a couple other family members, raise the rest of the down payment and do it that way.
Maybe.
So I think if you think in advance what your story is going to be, then you've got a better chance. And it's not a case of you're a meanie.
No.
You got to protect yourself too.
Right. No one is as interested in your life or your financial health as you are.
Right.
No matter what they ever tell you, or no matter what they ever say to you, you're responsible for you.
Yeah. So my summary is if you have the funds, give them the money.
Right.
And then there's no expectation of repayment. It can't have any negative impact on you. You've capped your risk.
Right. There's no stress.
There's no stress. And if you don't have the money to just give it to them, you shouldn't be doing it.
Right.
So set your limit. Here's what I can give you, and that's what I can do. So final point then, the reason your friend is borrowing the money from you is their credit's lousy because they got a huge ton of debt.
Right.
So give us the 20-second commercial on why perhaps a consumer proposal would be the better answer for them.
First and foremost, if you go and apply for new credit and you're rejected, it means there's a problem with your credit history someplace. Most likely you've got more debt than a bank or financial institutions think you can handle. Well, that means you should talk to somebody about reducing that. The most effective way to reduce it, if you can't afford to repay the debt, is something called a consumer proposal, where you look and say, look, I owe $50,000. I can afford to repay $20,000 of it. Then we set you up on a plan.
And by doing the proposal and taking care of your debts, now you've got some extra cash flow, which you can perhaps be tucking away and building up the down payment.
Well, most importantly, it's supposed to give you enough room to maneuver. You're trying to take a situation where you're short every month. You know you're in trouble. Your cash flow just doesn't work. Now we've put you on a model where your cash flow does work. As you say, maybe you can set some aside or save it, but more importantly, you're not getting any deeper in the damn hole every month.
Yeah, and I certainly would not want to be loaning a family member or friend money to pay off debt.
Right. That's just a mistake.
Yeah, there's nothing good can come of that. I mean, okay, if it's $100 phone bill, fine. But,
right. But I mean, you know what's going to happen. So you give them $10,000 to pay off the credit card. Even if they cut the credit card up in front of you, they're going to call and get the card reissued, and they're going to be $10,000 in debt in 6 months, plus the $10,000 that you gave them.
Yeah,
so it's a bad idea.
A better solution would be to deal with the debt and then move on. So
Right.
So there you go. You can leave your questions or comments in the comments about how we're both mean and aren't loaning people money. But we have been in this business so long, and we've seen it go bad so many times that it's better to say no or to make it a gift. Then you're done.
Yep.
Simple as that. So. Okay, so that's the first time in 500 episodes that we've just had a scratched piece of paper, but there you go. I suspect the experiment will not be repeated, but
we'll see.
We'll see. So I will put in the show notes all the timestamps, information that explains what we're talking about. If you are watching this on YouTube, please like, share, leave a comment, leave a badge, do whatever you're supposed to do to make the algorithm love us. And if you're listening on Spotify, Apple Podcasts, whatever, same deal, share, subscribe, you know the whole routine. Right. I don't know how to do it myself, but it's not that hard. There is a new episode every Saturday morning. So if you're subscribed, then you'll get the little binging notification to let you know what is there. So until next week, that is our show for today. Thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.